Welcome, ladies and gentlemen. Thank you for participating in our Emerson Group community call for October 2022. I am the team owner and operator of the Emerson Group, real estate professionals, where we specialize in working with real estate investors with buying, selling, and reinvesting using 1031 exchange strategies. So today's call, we're going to talk about analyzing your rental property performance. Now, one thing I want to clarify is that this information is really good for if you own property, of course, yet it's also really good information if you're just getting into the investment space, as a lot of what I'm going to talk about is going to pertain to evaluating purchase opportunities, but also analyzing your existing portfolio or rental property as it pertains to within the residential side. So outside of that, I do want to make sure I answer everyone's questions today. And if not, I will be sure to follow up with them. But if you do have questions, please put them in the chat box. I'll be sure to get to them. And I'm looking forward to this is going to be a really informational and really dense call that's going to get you some great insights and set you up to take action, or set up an exploratory call to get deeper into the findings of your properties and what you're trying to accomplish. So we'll start off with a quick overview of the call today, where we're going to be talking about understanding your numbers, right? What does it look like as far as your income, your expenses, and really getting into each category. We're going to work through a scenario for a client that we just helped out with as far as calculating their return on their property and what we ended up doing. We're going to talk about reasons why investors make changes. Also touch on some of the most common misunderstandings or maybe mistakes that we might be making. And then lastly, what next? What are we going to do with this information? What are the next action steps that we should be taking? And where does that lead us? All right. Now, if there's, again, something you want to mention, a question, feel free to put in the chat box and we'll be sure to get to that as well. So the first thing we're going to do is just go through some of the basic information, right? Understanding your numbers, net operating income. So first and foremost, net operating income, net cash flow, these are synonymous terms. They mean the same thing. They typically get changed around interchangeably between both. No, they mean the same thing. Equity, how much cash do I have in the property? So my current market value less my mortgage or debt. And then I like to include selling expenses. Normally it's market value minus mortgage or debt. The reality is if you're going to realize that equity, you're going to need to accomplish a sale, and that's going to incur expenses. So let's make sure we incorporate the net equity, as I call it. Next thing is going to be depreciation. How much am I writing off each year? And what is my current adjusted basis? I'm going to have a couple of great resources to follow up from this call. One of them will be an Excel cheat sheet for how to figure out your current adjusted basis if you don't have it on file. Another one's going to be the condition. What is the current condition of your property? What are upcoming repairs, improvements, or larger expenses that might be needed? How much will they cost? And have we planned for those as far as what that will do to our investment and what decisions we might consider making? And then lastly, the mission. What is your main investment objectives? Now, I'm going to touch on this throughout the course of the call, but recognizing that oftentimes when you purchased a property 20 years ago or 15 years ago or even 10 years ago or even 5, your goals or objectives may have changed. Are you acting and making changes according to what your needs are for yourself and for your family and for your family's families? So really important, to make sure we're clear on that is I help a lot of clients out who, bought a property 20, 30 years ago. It was their primary residence. Things changed. They moved out of the area, and it's always been a rental property. But it wasn't actually purchased as a rental property. So it's helping people understand where there might be some gaps or there might be some opportunities for improvement with little to no extra work on your end. And I will do my best to keep it slow as I know a lot of this information may need to be going over a couple times to make sure we're clear on it, or again, ask questions if you need clarity. So this is a copy of an asset performance test. And really, this is giving us a baseline understanding of how our property is performing. So I'm going to go through an example on this, but I do want to go from top to bottom here really quickly to give you some feedback on how to fill this out. And then also acknowledge we will send some additional resource guide afterwards to help you look up some of this information if you do not have it. So the first thing we want to know, of course, is where's the property at? What's it worth? Right. So for a quick napkin number, you can check out Redfin, Zillow, get a general figure. Naturally, we provide a more revised, in-depth with a broker opinion. But either way, we want to start by just getting a base understanding of where are we at, and then we can refine from there. If it's clear we're kind of in that area where we might need to be considering alternative options. So the next one's going to be, what's the gross rent, right? How much am I bringing in each month before any expenses are incurred? Heading into the expense category, we're going to go through the repairs and maintenance. So there's a quick little cheat sheet number here as far as putting together your living square footage divided by 12. That's one way to do it. Generally speaking, it depends on the property, right? If the property's been taken care of, I'm usually going to allocate for $100 to $200 a month for a repair budget or maintenance reserve. Naturally, if it's an older home and it's had needs a lot more repairs and maintenance, that probably is going to be a higher figure. Another way you can look at that is if you are having your property professionally managed, or if you are in fact taking great notes on your property, you can go back and put together kind of an average of each year of how much money did you spend on repairs and maintenance, and try to create kind of a standard number that meets what your property's kind of financial rhythm is for repairs and maintenance. The next is going to be property taxes. So if you don't know your property tax bill, you can go to San Diego Tax Treasury, which will provide a quick link to that. You just need to put in your bill or your parcel number, or if you need help, we can help you out in finding that as well. Insurance, check with your insurance company for your statement if you do not have it. Generally speaking, for insurance, we're typically writing anywhere from $80 to $160 a month. Naturally, that depends on if it's one unit or multiple units. The association fee, this would be the HOA, if it is in fact in a community. And then below that, we're going to have our total income and total expenses to arrive at our net operating income or our net cash flow, right? So what this would look like is some other items maybe not on here is property management fees. Maybe you have yard maintenance or a recurring trash collection. There's all kinds of other extra fees that might be coming up, but that's something that we expect if your property is managed or taken care of, you'll have that in your files to refer to. Now, what we're going to do with this sheet is we're going to come up with our capitalization rate, right? Which is essentially what is our net operating income or our cash flow divided by the fair market value. We're also going to look at the return on equity, right? Which gives us a really good sense of how hard is our money working for us. All right, so let me set the scale here. This is a client who's actually closing escrow on the 1031 exchange purchase today. So this is something we just accomplished here in the past 3 months. Our client, Miss Begg, she owned 2 condos in the Adobe Falls complex here in San Diego. Both had been owned for over 30 years. She owned both of the properties completely outright, so no debt on the property. And she was collecting for one of the units, right? For clarification, this is just one of the units. She was collecting $19.50 a month for rent. Now, we looked at her repairs and maintenance, her property taxes, which one thing I want to point out is because she's owned the property for a long time, she had a tremendous property tax rate. At the same time, what we'll find out is that that doesn't dictate being a good investment because you have a low property tax rate, which we'll find in the numbers here. Insurance, the HOA 400. So we got to a total income of 23,400 with total expenses, which is not accurate, of 955. check that, make that about 12,000. And the net operating income came out to 11,940 on the year. So what does that mean? Well, when we ran the capitalization rate, which I'll go through the formula with you after this, we came up with 2.3%. Now, is that good? Bad? Well, let's just say you can go out in the marketplace right now and buy something at a cap rate at 4%. So if we know that we can go find a better position in the market today with higher interest rates, that's near double it, it's a pretty good indication that we're already seeing that this property is underperforming. The next status that we put on is the return on equity. So as I mentioned, and we'll go through on the next slide, the return on equity is going to be your net operating income plus your principal buy down plus any appreciation. And then lastly, another item you can include on that is a depreciation benefit. Now, in this case, this is a great example because Ms. Begg did not have depreciation. As I've mentioned, she'd owned both these properties for over 30 years. So there was no longer any depreciation benefit. So we were filling in 0 for that number, and we were filling in 0 for the debt buy down. So I'll just pause for a moment, just take you to the return on equity. If you look at the Adobe Falls example here on the slide, this is our net income, net operating income for Adobe Falls, plus the appreciation. And then she did not have any depreciation or debt buy down, right? So this is a great example because it just shows you you're already losing out, right? Your money's not working as hard as it could if you had debt buy down and depreciation included as some additional offsets. So we came up with a return on equity for her of 5.5%. Now, again, is that bad? Is that good? Well, for context on that, I reviewed a property yesterday. This is a duplex in Tennessee, and the return on equity in year 1 was 17%. So one thing I do want to acknowledge is your return on equity is going to go down over time, right? Because your equity is going up. The larger the equity gets, the more money you have to yield to get a higher rate. Naturally, the equity is going up higher than rates are for rental rates. A couple other equations I wanted to put on here was the return on income, which is the difference between the return on equity and return on income is you're using the initial investment versus the current equity. Now, something I like to point out here is personally, and there's no one size fits all here. I think that's one thing we're going to take away from this call is that I'm more inclined to want to pay attention to what the current is than what the past was. And what I mean by that is, yeah, it's awesome that I'm getting a certain return on my initial investment from year 1. And yet I want to be making decisions that are taking into consideration the equity that I have in the property right now, because that's real money that I can liquidate and sell the property, right, that I would own. So it's important that I'm taking into consideration the equity and what I can do with it so that I'm making, decisions that are relative to where I'm at or what I could be doing with it. Whereas the return on income, it's always going to look phenomenal from an initial investment when you're down the road, right? Because your income just keeps going up and the initial investment stays fixed. But again, this is one thing I want to point out in this call is that it's really about an art and a science, right? There's not one size fits all. There's not one metric that you should use per se to qualify whether it's a good or bad investment. We really like to preach having a holistic approach, right? Which is understanding all the elements of the property and making a decision on whether it serves us or not, and not just, what's our cash on cash, right? Because there could be other things that we're not factoring in that might dramatically increase the benefit of the property. So the other one I wanted to talk about is the cash on cash. Now, the cash on cash is typically the most cleanest when it's a cash purchase, right? There's no debt, interest, or any of those other line items involved. However, I also like to run cash on cash with looking at my net income compared to what my equity is now, right? Which is similar to return on equity. It's what money is my equity making for me on a net basis per year. So first, another thing I wanted to mention with cash on cash is this would be one that might be more common to use when you're looking at buying properties, right? What is the cash on cash factor when I'm looking at it as one of my buying criteria? Whereas again, cash on cash, if I use initial investment, it's going to look tremendous oftentimes down the road. But again, we want to get a really good snapshot of today and where we're at and what chips do we have to consider for reinvestment or to increase the investment that we have. Now, this is a lot of information, a lot of formulas. Recognize everyone doesn't enjoy waking up on a Saturday and filling out a cap rate and a return on equity. So I want to mention this is something we do for you through our asset performance test. So if you do want to get a clear sense of where you're at, it's something we're happy to provide for you. Before I do go on to the next slide, is there any questions that someone has on this? Any ahas, or maybe something that I didn't mention that you feel has helped serve you well in your investment journey or career? Feel free to chime in. I'll give everyone a second. All right. Why and when investors make changes? So oftentimes there's a lot of different considerations that go into it. But I want to make sure I just provide some examples of reasons why people choose or decide to make reinvestment decisions, so that you can understand how it might apply to you, or maybe some considerations you may have not been thinking about. So the first one is really to increase our cash flow, right? Well, and in this case, we want to make sure that we know where we're at, right? What is the current cash flow that we're making per month right now? So first, if we're clear on that. Now, here's a great example for this. And this is a conversation I just had this week. A client called me. They have 2 condos here in San Diego. Both properties were purchased about 3 years ago. So they both have a good size portion of equity in them, but they're currently performing with a negative cash flow. So what we're looking at is, great, if we took the equity that we have in these 2 properties and we looked at all the viable options available to him, what would that look like? Well, in looking and studying other markets and knowing what's going on for other possible income property, one clear option is that he can take this, $300,000 of equity, and he could reinvest that money into a more cash flow positive location. Oftentimes, for myself personally, I'm looking in markets such as South Carolina, North Carolina, Tennessee, Texas. Those are locations that I'm personally looking at, and I have active feeds on. And looking at those markets, I can tell this client right now that with $300,000, you could split that into 3 down payments and buy 3 duplexes with a 30% down and a $400 to $500 cash flow. So we can take his, net negative $400 a month and turn that into, a $1,200 positive, right? That's a $1,600 swing for him with his investment properties. Another example is appreciation in growth markets. So an example of this might be San Diego is a great example of what's been a great growth and appreciation market. Right? The cap rates are not as attractive as other locations, but these are trade-offs, right? There's no bad or good here. It's just, what's your flavor? For an appreciation or growth market, you might be more interested in the long-term benefit of the equity that you'll realize over time, right? So instead of looking at a lower price property in another state with higher cash flow, you might be looking at higher quality properties in the coast or in California, or there's other growth markets as well. where we might not be getting $1,000 a month in cash flow, but over the course of time, right? I mean, San Diego is a great example of this. Within the past year, year over year, we were 20% up as far as value goes. Well, if the average price in San Diego is $800,000 and you're up 20%, that's $160,000 of equity growth. I don't know about you, but I might be interested in that type of return if I was going to pull that out, more so than I would a couple $100 a month for my cash flow. Now, of course, other properties went up during that same time period, but the rate at which they went up and the price points is a much different conversation. Another example here is consolidate and diversify. So a couple examples of this would be, maybe you have a portfolio of detached properties, right? We've got 10 detached homes that we own, and we're tired of dealing with 6 different mortgages, 7 different servicers, because the loan changed. I've got 5 different property managers, and right, I've got a different lawn care and recurring expenses on each one. That just sounds daunting. So what this client did is they sold the 10 properties and they reinvested into 2 apartment buildings, right? So they took their, what we call an economies of scale, right? The benefit of that, they took the 10 roofs and turned it into 2. They took the 6 different mortgages, turned it into 2. So they really were able to bring in all their assets into 2 much larger assets that, yes, had better cash flow performance and help make sure they didn't have so many things to keep track of. Plus, you're going to realize a lot of benefit from not having to replace 10 roofs. Usually 1 roof is less expensive than 10. So that was a great opportunity for them. Another example from a diversify standpoint, which there's a couple layers to this, is diversify could mean a multitude of things. One of them could mean diversify geographically, right? So let's just say, God forbid, you owned your rental portfolio in Tampa, Florida, and the entire portfolio was wiped from a hurricane. That might be a good reason why you'd want to diversify geographically. If you're in locations that have a higher prevalence of natural disasters, you don't want to put yourself in a position where all of the assets you have are in that location. Another type of diversification might be the asset classes. So instead of owning 10 detached properties, you decide to reinvest some of those detached homes into a multifamily, or you look to a portion of that into short-term rentals, or commercial. Either way, you're diversifying in different asset classes, which naturally they should not correlate directly together with each other. So if there is market shift, economy concerns, you're able to mitigate that a little bit further with having kind of a mutual fund effect with having different asset classes and different geographic locations. Now, another way, of course, could be diversify into other investment alternatives, not just real estate property per se. So there's a lot of different ways you can go about doing it. And again, there's no right or wrong way to do any of this. It's just a matter of what is going to meet you with your needs, with where you're currently at on the investment journey. So next one is tax strategies. So Troy will appreciate this one. Troy's on the call and he helps clients with the Delaware Statutory Trust. With that could be with retiring from being a landlord. So Troy, thanks for joining us on the call. The tax strategies. So this is a conversation that I think a lot of people might miss out on as far as what you could benefit from when you're given the right consultation or advice and the right opportunities. Talking with one of my tax professionals the other day, the example that he shared with me, which I had wished I had known about, was that he had a high income earning client who was bringing in about $600,000 in income. And so he was going to be faced with a very large tax bill. What he did was he bought 5 detached properties and did an accelerated depreciation. So he wrote $100,000 off each of those properties. So at the end of the year, his $600,000 income was deducted by $500,000 in depreciation acceleration. So he took his $600,000 taxable income to $100,000 taxable. Now, this is a great example of how he didn't receive cash in his hand by virtue of a tenant paying it, yet he did receive a huge benefit in the form of tens of thousands of dollars of not paying income out. So if you saved $150,000 on income, would you be okay if that property was only making a couple $100 a year? Well, for that year, yeah, I would be okay with that. I would say that's still a net benefit of $150,000 I wouldn't otherwise have realized. Another example with depreciation is just understanding where you're at in the depreciation game, right? So just a base level of depreciation, just to recap this. Your depreciation table is set when you first purchase the income property, right? It has to be income property. You can't depreciate a primary asset. How that's allocated is your tax person will allocate a percentage of the price towards land and a percentage of the price towards improved value. Now, what's important about that is the land cannot be depreciated, right? It doesn't have a useful life. At least we don't know that yet. The improved does have a useful life. And what the government has said is that that is typically through a straight line depreciation method, which is 27.5 years. So buy a property today for $1 million, right? We've got 600,000 is towards improved and 400,000 is towards land. We would be taking the 600,000 and dividing that by 27.5, right? That is your depreciation. So if I were to just do a quick napkin number on that, just so I can bring that to life for you, we take 600,000 divided by 27.5. That's approximately $21,800 towards depreciation. So how does that work? Well, every year, your Schedule E, you're going to be writing off that depreciation to offset your income. So when you write that depreciation off, though, what happens? Your basis is adjusted downward, right? So if my 600,000 was for improved and I was writing that off, year 2, right, I would be deducting, call it $22,000. And now I'm at $578,000 for my adjusted basis. So as you can see, over the course of time, your equity position or taxable proceed amount is going to go up, right? Because your basis goes down, your price is going up over time. So this is what ultimately ends in people being stuck because they have a tax problem. But at the same time, the depreciation is a benefit because it's offsetting your rental income. So in Miss Begg's case with her Adobe Falls condos, she no longer had depreciation. So any income that she was collecting from that was going to be taxed with no offsets. We have to understand that that is a financial benefit that she's no longer receiving, right? So that's one less thing she's getting of value from this property. And so how many other things are happening like that we might not be aware of, and we still think the property is a cash cow, right? We need to be clear on all these different quadrants so that we're properly analyzing the property as a whole, not just one component. So the other plug that I had for Troy was talking about the retire from being a landlord, right? So one of the options that we have is a deferred sales trust. This is a completely passive investing approach where you're to reinvest with a 1031 exchange. The Delaware Trust is normally a fund that is acquired. Examples would be a storage facility, maybe a large apartment complex. We're talking hundreds of units. Class A commercial building with Fortune 500 tenants, right? These are the types of DST funds that are put together. It's usually one asset with a large fund, and the amount of action or involvement you need to have is walking to your mailbox and walking back home to open it up and get your cash for each month. So that's another alternative. Now, is that going to get you the highest cash on cash or your highest return? No, that's why it's passive. It depends on what you need, right? Some people would prefer more time than money because they have enough money. Other people don't even know they have enough money and they still prefer to use their time. So it really just depends on where you're at in the, the season of life and what makes the most sense to you. So any questions on some of these scenarios or anything that maybe you had an aha about, please feel free to put a message in the chat box there and I'll be sure to get to it. Okay, we'll talk about some of the most common mistakes or kind of pitfalls. And I want to preface this by saying that if you're invested in real estate, you're already ahead, right? There's not a mistake in that. Oftentimes, just we're looking at some of the things we might not have been considering, or maybe we just haven't checked in on things, right? Life is busy, and we haven't thought to look at where we're currently at or what's going on because there hasn't been a pain point. And that makes sense. So let's dive into really what are the most common, some of the things that we see. One of them really just not staying current, right? You don't know what you have. And this is a pretty common situation where the clients had the property for a long time and hey, it's making more money than I have to pay out, so I'm good with it. But when we look at it, what we find is that there's an opportunity there that they may have not seen before, right? Especially in these properties where there's a lot of equity. We need to be mindful of what we can do with the equity and how we can make our money work for us. I don't know about you, but I'd rather work less hard than work harder when I have the opportunity available to me. Just that most people don't know they have the opportunity. So staying current, know what your numbers are. Do you know what the performance of your property is? Do you currently know how much equity you have? Do you know what your monthly income is from the property net? That's important, right? In order for you to know whether or not you're in a good or a bad situation, you have to know where you're at relative to what the opportunity is. If you don't know what you have, you don't know whether or not the opportunity is good, bad, or break even. You don't know. So be current and be real on where you're at today. Next thing is not using leverage or debt, right? For some reason, there's a negative aura in some cases around having debt and would prefer to own cash. Now, don't get me wrong, you're in a phenomenal opportunity if you own property with no debt. And yet, at the same time, there's an opportunity there that we might be missing out on, right? And one that I talked about was debt is an opportunity for a write-off, right? You're going to be paying down principal balance, but you're going to be paying interest, right? And those are things that you can be writing off towards the income. Additionally, especially in the environment that we've been in the past, 6 or 8 years now, before rates have gone up here, we were in a really low interest rate environment. So debt was really cheap. Now, I don't know about you, but if I can make money off of someone else's money and someone else is paying that down, that sounds like a pretty good setup for me. So make sure you're clear that you need to be looking at opportunities through the lens of how much debt do I have on the asset? If you own something outright, what are my options? If I could reinvest this in, this equity that I have in this property, and that affords me to buy, a fourplex or a commercial building, does the leverage really matter if you're still making more money and building more wealth for your family? That's up to you, right? Some people choose not to have it, but I think that's something you need to be very clear on, is making sure you understand that a debt leverage, that is a tool in your tool belt, right? And something you can use to your benefit. So if you have properties that are owned outright right now, I would just understand what's available to you and what the options look like. And if you choose it's not for you, it's not for you. That's okay. As long as you know what your options are, that's what's most important. The third one is not coming from a holistic perspective rather. And that just goes back to, I'm guilty of this, right? I would first look at properties and if the cash on cash wasn't a certain number, in the first year, I would immediately write this property off. What I recognize over time is that is very short-sighted, and I need to be looking at a property from a much more well-rounded standpoint. What I mean by that is, oftentimes when I'm looking at investment property, I want to know how many advantageous benefits might come from the property in the form of not just income, but what other options are there for the property? Other than, short-term rental, can I do, or I'm sorry, long-term rental, can I do a short-term vacation rental? Can I do corporate rentals? Can I convert garages? Can I add an accessory dwelling unit on the back? Right? Is it a lot that has a new zoning to it, so you can add way more density to the property? The more opportunity you have, right, the better insulated you are from risk, because if one's not working, you have alternative options to increase your position. So all things considered, if I had to choose, I would be more inclined to look for something that has additional add value options. Whether I exercise them or not is irrelevant, but rather it's knowing if I'm going to put my cards in, I want to make sure that I have the most potential outs and options to generate income or get out of that asset down the road if I need to. So really coming from a holistic approach and understanding all those components of it, and also not just looking at it from cash flow, but understanding the growth of the environment there for appreciation, the opportunity for write-offs, and then also long-term, what that might look like for you as far as, is that going to be in a location you'll be in? Is it a location that you might have family in, etc.? All these things play into dynamics of whether you own real estate or not. And I'm an example of that. My parents are moving to South Carolina, so I'm looking in South Carolina for investments. It just happens to be a state that's better cash flow than others. So it just depends on what your situation is, but understanding it's a really much more comprehensive approach than just looking at a specific metric for, cash on cash or return on equity or return on investment. Those are important, but we need to understand all the options, right? And this comes with having a professional too. So the other one I wanted to mention that I thought was really interesting is that most people have a CPA, a tax preparer, they have a financial advisor or financial planner, but they don't have anyone to consult within the real estate space, right? So generally they're asking sometimes their financial advisor or CPA about what they should do with their real estate portfolio. Well, wouldn't it make sense that we're asking someone who's a real estate professional or a real estate planner rather? And really what's important about that is that I believe that unfortunately in our industry, agents have taught consumers that we are transactional based. So call us when you're looking to buy or sell. But quite frankly, a real estate planner and what we offer to you is that we're coming from a more comprehensive lifetime approach. And what I mean by that is we're having conversations, we're running through, scenarios that are helping fund your life. Whether it's now, 10 years from now, 20 years from now, we're not having conversations about just buying and selling real estate when you're ready. We're putting together a plan for understanding where you're at, where you want to go, and what does it look like to get there, right? That's huge because that's a space that's not being filled right now, and a space that people really need because they're not getting the advice that's suiting them from a bigger picture and more generational standpoint. So 4 common mistakes: not staying current, not clear on what you currently have and what that is relative to opportunities in the market, not using leverage or debt to help you, in some cases, make more money, not coming from a holistic approach, right? Not looking at all the aspects of the property, just looking at maybe 1 or 2 metrics. Right? You want to understand a lot of things about that property, not just what's going on with the cash on cash, right? I want to know what's the growth in that market. Is there population increase or decrease, right? Is there companies that are coming into the area, which means there's going to be more stability from an economic standpoint? These are all the things that you should be aware of, and that when you're with the right people, right, the real estate planning community across the US, they're able to provide you with that context and information you need from a more macro and micro at the same time. Let me know if anyone has any questions on that. All right, so a lot of information, a lot of considerations. What the heck do we do with all this stuff? Well, First, we need to reinspect what our investment objectives are. Are we clear on what it is that we want or need from our properties? And do we know what we're getting right now? Right? Oftentimes, if you purchased a property, like I said, 20 years ago, what you need from that property 20 years ago and what you might need today might be entirely different. So understand where you're at and what is it that you need. Are you getting ready to retire in the next 5 years? So you're really on a push for cash. You want to make sure you can really shore up a great recurring passive income stream. Are you maybe getting ready to have kids or already have kids, young kids, and you know you're going to have some large college tuitions coming up, right? That might be a space where, look, I need to be buying real estate in a growth market where I can let it build equity and I have a large sizable position in it by the time they go to college so I can fund that for them. So there's a lot of different, of course, stages of life where what you might need and where you're at is going to change over the course of time. And just make sure you're clear on where you're at and where you're going, and that you have the appropriate portfolio or property to help you accomplish that and allow you to, quite frankly, more time to enjoy with your family and friends instead of toilets, tenants, and trash. Second thing is, once you're clear on kind of what your investment objectives are, complete the asset performance test. So with the asset performance test, we will send you guys a quick resource guide that'll have links for how to look up your property taxes, right? How to find these different bills so that you could make sure you can fill it out as easy as possible. Also, this is something we do for our clients. So if you're on this call and you're overwhelmed and you don't like numbers or you don't want to deal with it, this is something we can put together for you and go over with you so you understand where you're at. After we complete the asset performance test, the next thing is decision tree, right? What does this mean? Okay, I completed the test, and based on the information, it looks like my property is underperforming. What should I do? Or maybe we just start by saying, hey, I did it and everything's fine. I don't need to do anything. Great. At least you know you don't need to do anything, and that's peace of mind. However, if that's not the case, then it's okay, well, it's underperforming. What do I do now? Well, what's your investment objective based on what you established? Is it you want to increase cash flow? Or maybe it's, hey, I'm in my prime income earning years. I don't want to increase cash flow. That's just going to create more taxes for me or more problems. I really just want to have it in assets where I know it's going to grow over the course of time. So as we understand the decision tree, where are we at? What do we need? We've completed the asset performance test. We have an idea of where we're at. What are we going to do next? Well, the next thing we're going to do is we're going to start looking at our national network and start reviewing options for investment, right? What are our options? If I were going to sell this property with this equity available to me, what would I do with it, right? Would I go buy a property in a different state? Would I leverage to a multifamily? Or maybe I would get out of the detached multifamily space altogether. Maybe I'm looking for something different, like a syndication fund or a REIT, or there's all kinds of options available to you. So these are all things that we're having conversations with daily, right? So it's understanding, hey, this is where I'm at. It's underperforming. Nick, here's what I have. Let's reevaluate it based on this. This is what I would like to happen next, as far as I would like to yield this amount of money off this if possible. Where could I do that out? Or what am I comfortable doing, right? What would I be okay with investing in if I knew it hit this marker, right? Having that clarity is important because then you can make buying decisions. All right, the last one is to take action, right? It's to, once you have where you're at, what your objectives are, what your property is performing at, and what the available options are, then at that point it's to say, great, this is my plan, I'm going to reinvest it. Great, I looked at everything, I'm going to do nothing. Or great, I looked at everything, this helped me really understand what I can do with it, and I want to reevaluate in a year from now. But either way, what I want everyone to take away from this is that we were able to take a step back, Understand all the considerations that are important for looking at our investment property, getting clarity on exactly what our wants and needs are right now, today, and for the next 5 to 10 years, and then deciding whether or not it makes sense to make a change or not make a change. But at least put yourself in a position to get educated on what all the options are available for investment, right? And then making sure through that exploratory call, we understand what your wants, needs, what your current position is, and how we can better your position depending on what your needs are, right? So I trust from this process that you'll understand that we have the network, the knowledge, and the experience to really help guide you. And maybe it's doing nothing, but either way, it's understanding where you're at so you can take action and be appropriate in the moment. So with that in mind, and me having talked for the last 30 minutes straight, is there anyone that has anything they want to share as far as an aha, a question, or maybe something I didn't speak to that I thought might be helpful? I certainly hope that everyone got some value out of this call. And I also wanted to share that we are doing our 7th annual food drive and pie giveaway this year. We've got a virtual donation goal of $1,500, which is good for 1,500 meals. And then we're also doing an in-person canned good drive as well for 500 pounds. So I trust that everyone on this call can help support us in accomplishing our goal this year. We certainly have some makeup room from last year to make good on. So go ahead and pull out your phone, get the camera feature out. You'll be able to click on this QR code and pull up the site so that you can donate. All donations are very much appreciated and go to the San Diego Food Bank. Outside of that, I want to let everyone know we're doing our next call in December. We're going to be doing an end of year recap for the market, and I'm going to be doing an open question and forum. So an opportunity for you to ask me any questions that you might have. And then on top of that, I will certainly look at doing a national pitch session where we might be able to bring on partners across the US and let them pitch an opportunity for investment. Does anyone have any feedback on that? If that might be something of interest, because I think that would be a tremendous opportunity to learn about other markets and maybe other investment vehicles that you might not have otherwise known about. Is everyone agreeable that that might be something of value? Please let me know by leaving a comment, or feel free to follow up on it. And outside that, all you parents, grandparents, have an amazing Halloween. I trust that you guys are going to be walking home with a healthy sack or bag of plenty of candy for the holiday. Thanks so much, you guys. If you have any questions, if you'd like to have an asset performance test completed, feel free to text me, email me, pigeon carrier, website, whichever floats your boat. And thank you guys so much for your participation today. Had a lot of fun, and I hope you got a lot out of this call today. Look forward to continuing this value conversation into the new year. Take care.